Okay, in this video, I want to complete talking about cost of capital here and with just some adjustments, if you will, a little bit of corrections, adding a little sophistication to some of the tools. The first one is to talk about cash, right? Again, if companies have lots of cash, cash is a risk-free asset. And because the risk of the firm's enterprise values, what we're really concerned with, when we talk about debt, we should talk about net debt. So net debt is the debt of the company minus any excess cash and short-term investments. Now, how we identify excess cash, that is the trigger, right? So the company has to determine, exactly how much excess cash they actually have. So here we have a company in mid-2015. We had $340 billion in capitalization, $350 billion in debt, $96 billion in cash. Equity beta was 0.87. So they want us to estimate the beta of its underlying business enterprise. So now what we want to do is we want to incorporate in debt. We need to incorporate the net debt. So net debt is the $35 billion that they have minus $96 billion in cash. So the net debt is actually a negative number. So remember, we're subtracting here. You're supposed to add in the numerator. It's supposed to be debt plus equity, but in this case, debt is negative. So in this case, the underlying beta of the enterprise value turns out to be 1.06. Obviously, this is different, right? Their current equity beta is 0.87. So they have made this company actually became Microsoft, it's less risky than its underlying business activities because of its holdings in cash. We can also talk about industry asset betas. This is a little bit more difficult to do. You have to identify the industry, first of all. With retail, you would think it's not all that difficult. But if you look at these companies, Saks, Nordstrom, right, two very high-end kind of retail stores, Penny's, Sears, really even Macy's to a great extent, are more middle-of-the-road kinds of retail stores. So I don't really think these are really close industry types of things, but they are relatively close. So what they have here, we have the ticker, we have their equity beta, and we have their debt to value ratio, and we also have their debt ratings here. So the idea is, can we convert this equity beta to the unlevered beta, because we now know the debt to value ratio. So in this case, the fraction of debt financing, that's 1 minus debt value is the fraction of equity financing for each firm. So using that, right, 0.59 here times the beta plus the equity beta plus 0.59 times 0.26, right? That's the beta for the debt. We end up with a beta of 1.13. So again, we can adjust by looking at the industry's beta itself. And of course, what we've done here is we've shown how that adjusts out. Here's that 1.13. Now we have all of these companies. If we do that for all of them, we can then average the beta. You can see that the average beta in this industry, asset beta, is 1.16. Now, we may want to adjust that. We talked about that with a previous video. We talked about the Hamada equation, where we can then take the asset beta and adjust it for the amount of debt that we have so that we can look at, again, equity betas for projects, for instance. And here's the example I did a while ago. In the brewing industry, here's the equity betas. This is what's published. Here's the debt ratios. And of course, here then, when we unwind those, that gives us the asset betas. So the average here was 0.657. And now we can have a revised company equity beta of 0.849. If we plug that into the formula, right? At this time, the 30-year T-bond was 3.66. The market risk premium was 8.1. So the cost of equity on average for this industry is about 10.54%. What else can we do is when we're talking about project risk characteristics, right? We need to understand that there are vast differences in the projects done in any company, right? Some industries, or some segments of a company may have been around for a very long time. They're involved in very stable, very mature industries. And other segments of the company may be something totally different. I think a good example of a company that has many different things going inside it is General Electric, right? I mean, they have appliances. They obviously have, they create jet engines, right? Many, many things they do. But one of the things most people don't understand about General Electric is one of their biggest sectors is their financing sector. So there is General Electric Credit, which is a huge financial company that offers debt to consumers, etc. But they also own one of the largest long-term care insurance companies as well. So, I mean, each one of those segments wants to do things. They want to do projects. What beta do you use when you're talking about their projects? It's very different from time to time. Here they talk about 3M. They have healthcare and computer types things. So obviously we need to adjust this so we can look at so we can evaluate the projects for similar lines of business. Another thing that can obviously affect the market risk of the project is what's referred to as operating leverage. This is the proportion of fixed versus variable costs. So the higher the amount of fixed costs increases the sensitivity of the project's cash flows and therefore its market risk. So higher fixed cost companies will have higher betas. So they then should also have higher costs of capital. So here we have a project, right? The expected revenue is $120 in costs and costs of $50 in perpetuity. So the costs are completely variable. So the profit margin for this project is going to remain constant, right? It's always essentially $70 here. Suppose the project has a beta of 1, a risk-free rate of 1, and the market's 10%. What is the value of this project? And then what is the value and beta if the revenues continued to vary with a beta of 1, but the costs were now completely fixed? How would that affect the values here? So again, the expected cash flow of the project obviously is the profit, $70 per year. 10% is the cost of capital. So that gives us a value of roughly $700. If instead the costs are fixed, then we need to compute the value. The revenues still have a beta of 1, and the cost of capital is now 10%. So the present value now is $120. So because the costs are fixed, we can't discount them, we should discount them at the risk-free rate. So their present value really is $1,000. So with the fixed cost of the project, a value of only $200, right? The project has a value of only $200. Why? It has $200 value because of the much lower risk-free cost of fixed assets. It's going to change the value of the assets. So now let's just change and try to finish up here and talk about the weighted average cost of capital. We now have to combine these. We talked about the cost of equity. We talked about the cost of debt. Now we have to put them together in a formula to calculate the average. And really this is half of the question, right? It's not easy, but it's rather simple to calculate the cost of equity and cost of debt. What the company then has to do, and we'll talk about this, we'll have a whole week of this in later videos where we talk about, well, how much debt should the company have, right? What is the weight of debt, proportion of debt to equity? That is another choice that the companies have to make. In this case, we also have to incorporate taxes. So when interest payments on debt are tax deductible, there is a net cost to the firm. So the effective after-tax interest rate is the return, yield to maturity, or whatever the promised yield is, times 1 minus the tax rate. So the weighted average cost of capital, WAC, all we do is change and deduct or multiply the second aspect, the second part of this formula, times 1 minus the corporate tax rate to reflect the reduction, if you will, in the total cost. Because the government, through the tax code, essentially subsidizes some of the costs of debt. So if we have a specific target leverage ratio, then what is the weighted average cost of capital? It's the return of the cost unlevered, right? U is unlevered, minus, this is the proportion of debt times the tax code times the cost of debt. So how do these two things compare with each other? The unlevered cost of capital, or pre-tax, this is the expected return investors would earn by holding the firm's assets. In a world with taxes, this can be used to evaluate an all-equity project with the same risk as the firm. In a world with taxes, weighted average cost of capital is less than the expected return of the firm's assets. Why? It's because the cost is reduced because taxes are tax deductible. It's rather redundant, but taxes are tax deductible. So here we have a company, market capitalization of 100 million, 25 million in outstanding debt. Their equity cost of capital is 10%, debt cost of capital 6%. What is its unlevered cost of capital if the corporate tax rate's 40%? What is the weighted average cost of capital? So again, if we plug this in, the unlevered, again, you multiply out, it's 9.2%. Notice here there's no adjustment for taxes in this unlevered cost of capital, or what they refer to as the pre-tax weighted average cost of capital. But we could use that to evaluate an all-equity finance project with the same risk. We can also, though, adjust this then, have the weighted average cost of capital, where we adjust the second part of the formula with 1 minus the tax rate, and that reduces the tax to 8.72%. So we use the weighted average cost of capital to evaluate same risk, same mix of debt equity financing as Dunlap's assets. It's a lower rate because it reflects, again, the tax deductibility of interest expenses. So there are a lot of assumptions that are made in the estimation of cost of capital. So how reliable are the results, right? So should we be concerned about the number of assumptions? So again, this is really no different than any other kind of financial decisions. They are all filled with assumptions and predictions. So again, the errors, right, are not likely to make huge differences in net present value estimates because the errors should not probably affect the total number. So maybe instead of being 8.72, it's 8.63, right? So sometimes it'll be less than 1% difference. So overall, it won't affect our capital budgeting decisions dramatically, right? But the capital asset pricing model is very easy to implement. It's pretty robust, right? It imposes a disciplined approach, and it requires managers to think about risk in the right way, right? Risk affects the costs of financing, and it affects, obviously, the returns that investors want and desire. So there are some limitations, but that's what business is all about. It's all about understanding that there's uncertainty and then giving yourself maybe some ranges of numbers so that you can incorporate ranges of outcomes that are potential. So again, that's the end of our video. I look forward to seeing you in the next one.